Well, hello, everyone. Russell Goodman, Supply Chain Brain, Senior Editor here, welcoming you to today's webinar with Parsyl. It's titled, What Has Your Cargo Insurer Done for You Lately? But all right, first to some business. Before we get underway, just a reminder that a Q&A session will follow the presentation today. So please enter your questions in the Q&A box on your screen as the program is unfolding. Our presenters today will address as many questions as possible before we sign off. But not to worry, any questions still pending, they will get to offline. All right, no doubt about it, supply chain risks are high these days, and mitigating those risks is paramount. How can we manage risk and optimize our supply chains if we are to make our next chapter as profitable as possible? Well, in our program today, Parsyl, a major player in cargo insurance, will demystify the industry for us. The company's CEO and Chief Insurance Officer will explore market trends and key drivers around cargo insurance markets and how these impact shippers. They will share tested strategies that shippers can use to generate savings on insurance premiums, even in a hard market, by leveraging their own data in more strategic ways. Well, here are some of the important questions that they will answer for you today. What are the main drivers of insurance premiums? And what causes premiums and coverage to change year to year? How do insurance underwriters evaluate risk? What are the missing pieces that underwriters need to better understand risk? And how can partners across the supply chain and insurance ecosystem work together and leverage better data for mutual benefit and cost savings? Our experts today, Ben Hubbard, co-founder and CEO at Parsyl, and Gavin Spencer, Parsyl's Chief Insurance Officer and former logistics leader at Marsh. Together, Ben and Gavin will walk us through just what your cargo insurer needs to do for you. All right, and now to our presentation and to Ben Hubbard. Ben, welcome.
Yeah, thanks, Russell. It's great to be here. Thanks for having us.
Ben, let's just set the scene if we might. I think it's probably fair to say that more likely than not, listeners have heard about more negative interactions with cargo insurers than positive interactions. Things that come to mind: rising costs, drawn out claims periods. So talk to us, if you will. Give us an example of a cargo client who had a positive experience and found value in their insurance. What would you say?
Yeah, well, certainly those examples exist, but certainly everyone has a story about working with their insurer, and unfortunately, they often can be negative. And it's important to remember we're usually dealing with our insurer on a really bad day when something very unexpected has happened. And more often than not, the insurer falls short in supporting you through that process. That's the unfortunate reality. And it's important to remember that the principal service you're buying from an insurer is a claim service. That is actually the product. But what that means in sort of most of your interactions with insurer are actually happening after something has happened. So Russell, I want to actually answer your question with a great example that I think sets the scene for today's webinar and illustrates how insurers can provide a service to shippers before problems arise, and hopefully helping them to avoid claims, or in the worst case, at least making that claims experience fast and painless.
Good, please do.
Yeah, so some of you may remember earlier this spring when the Ever Forward, it's a container ship the length of 3 football fields, it got stuck in the mud of the Chesapeake Bay and was run aground for well over a month. Now, eventually it was pried free. I think they had a big spring tide and a full moon, and they also had to remove 500 of the 5,000 containers it was carrying. But by the time it finally docked at the port of Baltimore, this is after 103 days at sea, we at Parsyl were prepared for the worst, because on the vessel was $340,000 of pasteurized crab that belonged to Asia Pacific, who's an insured client of Parsyl. And Asia Pacific was also ready for a total loss. This is a shipment that typically lasts them 45 days. It's extended to more than 100 days at this point. But unfortunately, a loss is not what happened. And so what happened was, upon arrival, that container was unloaded. Temperature data was wirelessly transferred from these Parsyl sensing devices we provide clients, and it was automatically shared with Asia Pacific, with ourselves, with the cold storage partner, who were all able to analyze the conditions of the goods, confirm that the crab meat actually stayed within acceptable temperature conditions. It was safe for consumption and safe for sale. And, look, many shippers filed claims with insurers as a result of the Ever Forward incident, but Asia Pacific was not one of them. And in this case, we were able to use Parsyl's technology, and it allowed everyone to avoid an expensive claim. We avoided expensive surveying costs, and of course, a massive loss of food. So in the end, Asia Pacific, they renewed their insurance policy with us, and they actually earned a 10% rate reduction. And I think that's a really great example. Now, even if this had resulted in a loss and we had paid a claim, the data would have resulted in cost savings for Asia Pacific, because we could have confirmed the loss without spending thousands of dollars on surveyors, claims costs that go on the client's claims record. That can help us subrogate the claim, meaning that we have data to recover funds from an at-fault party. And it allows us to pay that claim, in a matter of days versus the months it can take a traditional insurer to settle a claim. So that speed of payment is really important for many businesses who need that quick liquidity to make things right with their customers and their vendors. And, I love this example because it really shows how data collected at a granular level and available at the right time can power both an insurance solution and just as much a direct customer value proposition. So, Russell, examples like this really illustrate the future that we're certainly trying to build at Parsyl.
I would think that the listeners today also appreciate an example like that, because it is real world. Well, thank you, Ben, for that. But let me just turn to Gavin now for just a moment and ask a question. Gavin, when it comes to supply chain and insurance, I wonder if you could just step back for a moment and help our audience understand some of the basics. So first off, let's just define our terms. What is cargo insurance? What does it cover? Who buys it? And more important, why do they buy it? So what would you say?
Great question, Russell. When we look at marine cargo insurance, I think in its simplest form, what we're really saying is it's the coverage for the physical loss or damage to commodities themselves. Now, the thing that I find most interesting about marine cargo insurance is that despite its very simple context, it covers a very wide range, very broad spectrum of actual physical loss and damage. Now, when we talk about those goods can be anywhere in the world. They can be being distributed from Southeast Asia and transported to the US. They could be transported by any manner of conveyances, including ocean-going vessels, trains, trucks, and any manner of transportation method that you could feasibly think of. In addition, it covers not only transit exposure, but exposure that can be considered in storage. Now, that storage could be a distribution facility or a warehouse. It could be a manufacturing plant, and it could ultimately be a retail destination, such as those grocery stores or convenience stores that we shop in every day. So whilst it's very simple in terms of its application, the physical loss or damage for the goods that the owners are intending to distribute, its intention, its application can be as broad as global and as broad as any feasible method of transportation you can imagine. Some of the things that I've really enjoyed about marine cargo insurance and how I've learned so much about this industry in my 23 years participating in both cargo and logistics is really the notion that cargo insurance can be used to cover so many different instances. Obviously, there's the chance of a truck carrying goods driving down the freeway and having accidents and causing a loss to those goods. But in addition, we're also talking about coverages for things like piracy, things like hurricanes, natural disasters that we're also familiar with, including things such as wildfires. So just an incredible spectrum of loss that I've been able to witness both in my time as an underwriter, broker, a surveyor, and a claims manager. So when we talk about the application of cargo insurance, we're predominantly talking about it across 3 verticals. And these verticals really engage across every aspect of the supply chain itself. So in its purest form, cargo transit, stock throughput policies, it's the inventory, it's the goods, and it's the people insuring those goods who have title to them. So it's the owner, it's the manufacturer, it's the person who is physically responsible for that value on their balance sheet. When we're talking about the application of logistics coverages, we're really talking about those companies responsible for those goods when they're in their care, custody, and control. So your transportation providers, your 3PLs, your distribution agents, your shipping lines, they're the people really interested in those logistics coverages to provide coverage for their customers when the goods are in their care. And finally, a coverage that's been around for a while, but has become much more intentional, especially with the pandemic and companies looking to be more liquid, is shipper's interest. Now, this is very similar to cargo transit insurance, but it can be procured in a transactional manner. So it gives clients the affordability and flexibility to purchase insurance for particular shipments. Maybe they're higher value, maybe they're more specialized commodities, or maybe they simply don't have the funds to procure an annual policy to cover all of their goods. In addition to that, those logistics providers, they can also use shipper's interest as a way to create flexibility and cover maybe additional value for their customers, providing their customers with a more rounded product instead of just pure freight. They're also getting cargo insurance as well.
Well, that was certainly a comprehensive explanation, and I certainly do appreciate that, and I know that the viewers out there do as well. Gavin, when you think about it, we've seen a lot of digital innovation when it comes to home and auto insurance. At least I know I have, especially with the use of car telematics and smart home devices. So here's the question. I would imagine that the marine cargo industry is undergoing a similar change in the digital age. Is that so? And how were things done traditionally versus the way they're done today? And I guess if you were to put on, or to look into your crystal ball, the question would be, what about the future? So what do you say?
Russell, that's a really interesting comment. And I think as an insurance professional for the past 23 years, it's always disappointing to reflect on your own industry. And I think the reality is that cargo insurance hasn't been as progressive as maybe personal lines such as auto or property in terms of how they now look at risk. And I think the reality is that the traditional methods of underwriting are still those methods that are used in the majority of situations when we consider risk. So every submission we receive, every client risk that we look at, it's normally collated in a very similar way. So a client will have a relationship with a broker. That broker will have a relationship with a number of insurance companies. They'll create a standard submission looking at the general portfolio of that client. The underwriter will be looking at pretty generic information. And unfortunately for most clients, underwriters are really looking at portfolio risk. So they're comparing you against your peers, and they're really considering their own biases based on what their experiences have been with, that previous commodity or that region around the world. So they look at you in one way as an individual, but really what they're doing is applying general statistical analysis around, portfolio size and professional bias on previous losses. The other major factor for traditional underwriting is we're really looking at historic data. We're not looking at predictive loss for the future, which is ironic because that's the period of time that we're actually intending to cover through an insurance policy. So we're really using information that has been populated in a previous transportation cycle or in a previous customer demand. And the world, unfortunately, for underwriters changes so rapidly that some of those traditional techniques aren't really capable of considering what the future risks are. Many examples of some of this limited underwriting is really around data. Now, some of the major insurance companies and major brokers in the world have more data than you can possibly imagine. But the challenge for them is using it for an insightful period. how they apply that data still isn't being done on a granular level that really benefits clients in understanding their own individual risks. So when I talk about things like that, I'll give an example of, say, fruit. Insurance of fruit is generally looked at as a risky, fragile commodity. And that's partially because insurers and underwriters really look at it as fruit as a commodity, rather than look at those individual commodities that actually make up that portfolio. So, the difference between blueberries and cherries and apples is pretty significant. And, understanding that risk on an individual commodity basis can really impact how underwriters look at that strategy. And unfortunately, that's just not an area that traditional underwriting has been able to focus on due to their lack of clarity or understanding around that data. When we look at futuristic and more data-driven underwriting, one of the challenges that we really want to conceive is, how can we get more granular? How can we stop using portfolio as a metric for our clients? And how can we really look at individual clients and understand, based on the commodities, based on their own operations, based on their customer base, what is their actual risk and exposure? So one of the great ways to do this is to capture granular data around the supply chain, from both creation and manufacturing all the way through to distribution and delivery. What are those weak points within that supply chain, and how can we get that data? One of the wonderful things that exists in the supply chain is there is an abundance of data available. And I think if you ask the right questions and can provide this to underwriters, we can generate a real focal point around genuine risk and exposure. And to do that, we don't want to look at the past. We want to look predictively and understand, what does this information tell me about the future state of this risk? How can I understand my client's business in the next 12 months and apply to them a coverage and a condition that really allows them to do that? Now, as a traditional insurance person myself, I'm extremely challenged in understanding how we look at that risk. But what we need to do is surround ourselves with extremely intelligent, smart people who can use things such as machine learning, data and analytics, build algorithms to help us with this predictive, intentional underwriting philosophy. And I think that is really this hybrid area that traditional underwriters in the traditional insurance market really needs to focus on for us to really generate a sustainable and profitable industry around the volatile transportation cycle that provides the infrastructure for commodities that we're interested in. So Russell, that's really how I see some of these transitions and some of these expectations and the future of underwriting that benefits people like myself.
You touch on some of the technology that is absolutely critical right now in every aspect of supply chain. It's just top of mind for all executives, no doubt about it. Thank you so much for that drill down, Gavin. Ben, I want to turn back to you for just a moment or two. We've touched on some of the innovation that's underway with respect to using data to improve underwriting and claims. But I'd like to explore that a bit deeper, take that a bit deeper if we might. How should a listener think about using data to support their cargo insurance policy? I guess that would be the question for you. How does that, as you see it, how does that fit into the process? And then what kinds of data are we even talking about? So what would you say to them?
Okay, yeah. Well, I mean, look, there's a lot of different data that can be used, but you actually touched on something earlier, so I'll pick up on that, which is a consumer example that probably a lot of listeners are becoming familiar with. So if you've renewed your personal auto insurance recently, you've likely been given an option to collect and share telematics data with your insurer. And this is data that's produced by your car or a telematics app on your phone, and it gives insurers information about whether you're a safe driver. So are you a hard breaker? Do you speed too much? Are you looking at your phone and you're distracted? And usually insurers will incentivize their customers now to collect and share this data with them, and they'll give them an automatic premium credit for participating, even if you're a terrible driver. And if you're actually a good driver, you get even more credits and savings. And they do this because the data is really useful to them when it comes to segmenting their portfolio and pricing risk. And it helps you develop safer driving habits, which lowers everybody's risk. So a few years ago, this was novel. Some of you might remember the progressive snapshot commercials. It was the device that plugged into the port in your car. And today, really utilizing that kind of data is table stakes for any any auto insurer. And so when we think about moving cargo, the stakes are so much higher that it makes sense to apply a similar approach. A container of cargo, varies in size, but almost always it's more valuable than a car. And so the base level of data that I would say 99% of perishable shippers collect, whether they're big or small, is something pretty basic. It's time temperature data, and we really specialize in perishable cargo. So it's time temperature data from a data logger. So these are inexpensive devices, and they can answer a lot of questions, not all of them, but a meaningful number of questions. The challenge with most of them is they're not very digital. The data can be challenging to extract. It's almost never aggregated for insights. And that's why we at Parsyl, we've developed our own modern sensing devices, which we provide to policyholders and incentivize them to place them in their shipments and storage locations. And the data produced by these devices, it not only helps us determine whether a loss happened and to improve that claims process, like I described with Asia Pacific at the beginning, they also provide just a whole other sort of level of stunning insight when they're aggregated and analyzed over time. So we can start to help clients better understand, where were the near misses that happened? How is different packaging performance, different storage locations, different shipping lanes, vendor performance, lots of really interesting insights that can target operational changes and risk reduction. But there's the slide you can see on the slide, there's other data sources as well. So, for example, the reefer units that cool trucks and containers, they're logging data constantly. And increasingly, they're equipped with real-time connectivity. So partners like Carrier or Maersk, their Captain Peter product. They're great solutions that provide data and insights that can be used to understand what's happening in that shipping environment and to evaluate risk. The same transportation management systems, TMS, warehouse management systems, WMS, they can provide you with your insurers a granular view into your shipping pattern. So across different shipping lanes, storage locations, seasonality. So a really good example, you might be storing inventory at a third-party cold storage facility in Miami. And let's say you're turning over that inventory every 2 weeks. But if your insurer doesn't know that, they're likely charging you a rate that assumes you're storing those goods for 30 plus days. And that's going to cost you a lot more money than if it was priced at every 4 days. So this kind of data and insight can be shared through your broker to your insurer and save you money. So Russell, I think it's really about putting your data to work for you, being intentional about using data to present your risk to insurers, showing a willingness to collect data so it can be used to mitigate risk, and it's saving money, and sometimes a lot of money.
I like that, and I'm sure the viewer does too. Saving money, no doubt about it. We simply cannot have a conversation these days about risk in the supply chain without talking about the pandemic and the disruption that caused. But now, of course, we've got other factors that really need to be taken into consideration. We've got inflation. We've got a war going on in Ukraine. And of course, there are any number of other geopolitical situations that are impacting supply chains and making things uncertain, making things unpredictable. So the question, I guess, would be about the global dynamics here and how they are impacting cargo insurance and how are they impacting them. So Gavin, let me throw that one out to you. What would you say about that? What would you say about these global dynamics and the impact they're having in the industry? What would you say?
Russell, that's an incredibly topical conversation. I'm sure all the viewers here on the webinar have been impacted by many of these different factors without even understanding how that is impacting them. You mentioned some really key dynamics there, and I think highlighting some of them and the immediate impact that it has on our customers is really key. Let's look at Russia and Ukraine and the impact that's had on the insurance industry. Now, currently in Lloyd's of London, there's a $15 billion potential loss in the aviation market because of all the planes that were stranded at the time that the war started to occur. Now, many of our customers and clients in the perishable industry don't own planes, have no interest in the aviation market, but unfortunately for them, their insurers probably have a line in the aviation market. So to rectify that huge loss of $15 billion, those insurers are now having to increase in prices for all clients across all lines of business, meaning clients that have no individual interest in aviation are being penalized for those industry events. Same can be said of hurricanes. We talk about hurricane season every year now. It's not an anomaly. It's not something that should surprise us. But unfortunately, Hurricane Ian, we expect that to be the second largest hurricane incident in the insurance industry. North of $60 billion in losses. Now, most of those losses will be to the property market and more personal lines type insurance. However, again, majority of insurers have significant stakes in those industries. And ultimately, those numbers are going to impact cargo clients, despite them having no exposure in Florida at all. So, it's a real life scenario where, unfortunately for our clients, they're being penalized by market dynamics far outside of their control. The reality there is what we want to do is help clients understand the benefit of data to them and start empowering clients and customers to be able to move forward with sharing data that puts them in the best position to remove themselves from the impacts of those events. Now, I can't change the path of a hurricane, but hopefully through this journey cycle that we can take clients on, we can help them understand how to mitigate the impacts of that, how to present themselves as the best risk management client in their industry. And that's really key. Insurance only exists because clients have losses. And if you're a good risk management client and you have good risk management strategies and you empower yourself to understand your granular supply chain, you can avoid the attritional losses and the perils that really befit most companies. So taking that data, empowering clients to use it is something that we really believe in ourselves here at Parsyl and also in terms of the industry. So partner with a broker that understands this journey. Don't expect to do it all yourself. Have a broker help you. Have an insurance company that wants to use your data. Be on a journey with them and create a partnership with that insurer so that they can really value that data for you and you can start being judged as an individual client. So we start talking about putting the data to work. Some of the really key areas, and Ben's already touched on it, right? Saving money. This is a huge thing for our clients. Most of our clients pay 50% more than they paid 3 years ago, even if they haven't had losses because of the market conditions. So how can we start to reverse that trend and get them the benefit of that data working for them? Identify and avoid risk. If you can teach underwriters what your risk is and how you're avoiding it, you're a grade A client and you should be benefiting from that. You can earn premium incentives. You should be able to demonstrate that you're using technology. And because you're deploying your own money to use that technology to improve your risk, underwriters are benefiting from your risk management strategy. Therefore, you should benefit from premium reductions and credits. You should get the broadest coverage. If you're risk management incentivized and you really believe that you're doing the right thing and avoiding the losses, you should benefit from that. You should have that all singing, all dancing coverage that supports your infrastructure. Ultimately, claims, right? People buy insurance because of claims, and insurance companies, as we mentioned at the start, really struggle to show value in claims. But what they don't struggle to do is pass the cost of claims management onto you as the client, even when it's not a claim that is your responsibility. So as clients, through this data, you can start showing, I don't need a surveyor to go and take a temperature check. I have a device that tells me what the temperature is. Therefore, I can save $1,000 every claim or $2,500 every claim. And to give you an idea of that cost for most of our clients, for every claims dollar, 30% of that dollar is the cost of managing the claim, not the claim itself. That is direct impact to our clients' loss ratio. So clients empowering themselves with this data can immediately avoid those kind of price increases and start to reverse that trend of the cost. So Russell, I would say that data and clients that can use that data are in a great position in the current market to reverse the trend and impacts that they've suffered for the last few years.
Quantify, identify, and avoid risk, I believe is what you said. Very, very practical information there. And you're right. We get to share, in the benefits because of that. I want to stick with you, Gavin, for just a moment. Here is another, I would say, practical question. What is it that people can do? How can they get more involved, if you will, in their insurance program? And how can they improve it? So what would you tell them?
Well, the first and foremost thing is, I would say, is demand something different. Most of these big clients, they work with traditional brokers, and these brokers have wonderful resources and great relationships with major insurers, and they can leverage great results. But what clients must demand is, what is the alternative? Show me something new. Maybe that alternative isn't better. Maybe it doesn't reduce your cost immediately. But at least at this point, you're starting to investigate where's the direction of the industry going? What is that new thing that I should be looking at? And ultimately, bringing that differentiator from the market to your senior management, your treasury, your CFOs, and being able to demonstrate that if we go a different way, we can save, not just substantial money, but we can also mitigate risk. So empower yourself by using that data. Start to collect the information, start to preserve that information. And even if your broker doesn't ask for it, share it. If you share information with your broker, they have a fiduciary duty to share that with the insurance manager. They have to compel to share that with underwriters. And if you believe that information is important and shows you as a better risk, share everything that you can. The other thing is really around integration and utilization of all the technology that's available. Whether that's a TMS system that provides more analytics, whether it's tracking software, whether it's device management like we have here at Parsyl to monitor the temperature and the humidity of perishable goods, use that information on every shipment. Many years, clients have used that information just to evidence loss, but they haven't used that information to evidence how good they are compared to that one loss they suffered. So don't just share the bad information that shows you had a claim. Share the other 90% of your shipments that show you're a great risk, because all of a sudden you're changing the story, and you'll be able to change the story with an underwriter that lets them know, yes, I had a loss, but I also had 90,000 other shipments that arrived perfectly safe that shows that I'm a great risk. So the story for me is really a couple things. Empowerment. As a client, be empowered. This is your data. Control it, preserve it, and use it for your benefit. And the second one is demand change of the industry. The industry will only change when customers demand it. And by using that data to evidence it and demand that through your broker, you will see more things and more creativeness in the insurance industry than you've ever seen before. So I think really in summary, it's those major factors, Russell. And again, we want to demand that clients change, but we want to reward them for that change too. Be a better client, receive savings to your insurance premium, and create sustainable partnership with an underwriter. That should be the name of the game for 2023 for clients.
I think what I'm hearing is that you should not just sit back, let events take place, and then make a claim. You should be proactive. Very good, very practical information there, Gavin. Gentlemen, this has been a great drill down into this really, really critically important area, but we're going to get to some questions now because they're beginning to roll in, and we want to see what's on people's minds here today. Here's a great one. I like this question. The attendee says, who owns the data and where is it coming from? I'm going to throw that out to you both, or whoever wants to take that. Who owns the data?
I can take that. You own the data. It's your data. So or whatever data governance you have around your data. So, oftentimes we've talked about clients will be collecting temperature records. So that's data that's yours. And we're using it for underwriting purposes and really to pass on a direct benefit to you. So clients who use our technology platform, using our devices, they own the data. And that's sort of the end of the story there.
Mm-hmm. Mm-hmm. Incidentally, I'm throwing out these questions to both of you, if either one of you wants to take it, or if you both want to take these questions. And just a reminder to our audience, continue sending in your questions right now. And once again, any that we don't get to before the program concludes today, our presenters will answer offline. All right, here's one that's quite interesting. The questioner says, who tends to be responsible for buying cargo insurance? The risk management team, the supply chain operations department? Well, who would that be? Who really has that responsibility? What would you say?
Yeah, I mean, from our side, it's traditionally always been that risk management department. So what we're really looking at is an entire infrastructure of risk management professionals responsible for that portfolio management of risk within an organization. Now, depending on the size of that organization, that could be a little different, right? You could have effectively a treasury management infrastructure that looks directly at insurance procurement. But traditionally in large corporate companies, we're looking at a specific risk management. One of the great challenges that you have in terms of understanding risk, and when we talk about collecting data, is that normally doesn't fall within the risk management purview. And therefore risk managers have to go to their logistics coordinators and logistics managers and start to collect some of that data. So the hybrid future of utopia that we would love to see is risk management departments and logistics departments in these big companies working together to really demonstrate how great that risk is, because risk managers know how to convert that to broker speak, but you need that underlying data from the logistics team, and that will empower you to be in the best position moving forward.
Mm-hmm. Mm-hmm. Now, here's another practical question I think that's coming in. The attendee says they are interested in learning more, but as it turns out, they say they already use a temperature monitoring device, in their operation. So their question is, can I still get insurance from you, from Parsyl? Well, that's a great question. What do you say?
Yeah, absolutely. We're happy to work with you in whatever solution you have in place. And we have to validate sort of what's being used to make sure it meets our standards. But we work with a variety of third-party devices, equipment manufacturers, and really it's where the challenge ends up being is getting that device, off of the data off of a device, up to the cloud where it can be shared and kind of utilized in a modern way to get that value, that data analytics and insight value from it. As I mentioned, I'll just hold this up. This is a example of one of our little devices, a tiny little temperature sensor. You can drop it in a shipment. We have another one that's used for shipments or warehouse monitoring. It can sit there for several years, monitoring conditions in a warehouse. We've put a lot of work into making these devices really easy to use, really inexpensive, because that's what people want in that kind of situation. So sort of automating as much of the process as possible. And fundamentally, like the goal is to make sure data gets off of this and up to the cloud. But you still need to have this, with the cargo. That's how we understand what's happening in that environment at a granular level. It's how we were able to, prove that Asia Pacific didn't have a claim, led to, a rate reduction for them. So that's really important. But happy to consider a variety of devices. What's important to us at the end of the day is the client willing to collect data? Are they sort of taking that proactive risk management step? And then can we get access to that data so we can evaluate it for our own, underwriting and rating?
Ben, let me just stick with you for a moment and let's talk about these devices just a little bit, drill down just a bit more into them. For the benefit of anybody who has not actually used these devices yet, or needs more information about your estimation of how your device is something that is set apart from the others out there, walk them through that. Just what is it about your device there at Parsyl that you think makes it a superior technology? What do you say?
Sure. Well, our goal with all of this, whether or not it's our device or somebody else's, is we want modern digital solutions. So we want data collected to be free, to be able to be shared, to be able to be aggregated. And so, a lot of legacy solutions will collect data. That's great, but then it'll sort of trap it in a PDF, or it'll trap it on the device. And there's a manual process to offload it and extract it into a CSV, which needs to be emailed. And, you add enough steps, stuff stops happening, right? So what we see now with a lot of, in our case, because we're really focused on cold chain and perishables, a lot of data collection happening with these devices. That's great, but it's a missed opportunity because really right now they're being used in an exception basis. So I'll consult a device when I suspect there's a problem. Maybe there's an alarm bell going off. Maybe I'll pull the data off in that case because maybe I have a claim. But what we like to say is we want to learn from all the shipments. We want you to learn from all your shipments. So learn from the good shipments, right? Learn from the bad shipments, learn from the near misses. That actually can lead to insight versus sort of a exception driven after the fact. By that point, you're already losing, right? So how do we get ahead of the curve? How do we do things predictively? We talk about data at the right time. So, in some cases for certain customers, they need we call it a real-time solution. So those are cellular connected devices. They want to be able to follow that shipment in real time. That's a certain use case. You spend more for it. Other cases, actually, for your regular shipping, you need something that's not real time, but digital and accessible and available at the right time. And that's where some of these devices start to make sense. So we really kind of evaluate, what does the customer need? What do we need to see from a risk mitigation and risk prevention standpoint? And that drives the solution.
That's a great overview of that technology, I must say. Very good information there. We have time for just one more question because time is growing very, very short. And Ben, I want to stick with you and have you answer this question. Attendee says, how do we know this idea of data-driven insurance is here to stay? So let's let that be the final takeaway, if you will. How do we know this idea of data-driven insurance is here to stay? What do you say?
Yeah, Russell, I mean, I challenge you to find any industry that hasn't been improved or even revolutionized by more transparency and better data. Again, like we've talked about throughout this webinar, just look at what's happening in auto insurance with car telematics. Look at what's happening in home insurance using smart home devices and satellite imagery. These are forerunners to what is starting to happen in cargo insurance. So, just as consumers can now expect to benefit from putting their data to work with insurers, companies should too. A lot of what Gavin was talking about is that this is something you should start demanding and expecting from your broker and your insurer. And as Gavin described, like you're being treated like an average right now. You're at the whim of all these market trends and kind of global forces at play, which are completely out of your control. And putting your data this is a way to take some control. We find that companies are swimming in useful data. Most want to put it to work. And this is a case where it can achieve near-term hard dollar cost savings on a premium spend. So cargo insurance it's a big expense for most companies. And if you can save 10 or 15 or 20% on your insurance premium in the next year by doing some very simple things and being more intentional about the way you collect and share your data with the insurer, that's massive. I mean, that's savings in the tens or hundreds or even millions of dollars for some companies. So I guess I'd say if you're an insurance buyer for your company, you now have a lot of reasons to go speak to your supply chain colleagues about how to use their data more strategically. We talked about some of those data sources today. If you're on the logistics side or the supply chain side of your company, you should go talk to your finance or treasury or risk management department about the data that you have that can help them. So Russell, I think just to sum up, I think either way you can sort of be the hero here. You can revolutionize how your company buys insurance and save money and reduce your risk.
Once again, those departments should never be siloed. They should be speaking to each other. They should be collaborating, trading information. Everybody wins when you do that. Excellent takeaway, great information, valuable information, Ben. Thank you so much. Folks, do yourself and your company a favor and talk to your broker. Ask for a quote from Parsyl. And you can learn a great deal more at parsyl.com/insurance. All right, gentlemen, some terrific and highly useful information for everybody, but we're going to have to leave it there right now. That's simply all the time we have today. Folks, any questions we didn't get to during today's presentation, our presenters will answer offline. All right. Many thanks to Ben Hubbard and Gavin Spencer of Parsyl for sharing their time, experiences, and expertise with us today. And a big thanks to you for attending today. Until next time, this is Russell Goodman of Supply Chain Brain saying so long.